Hi, it's the 27th of October. Normally I would do Harry's take with an article and a cool chart or something, but today I'm going to do it video because there's a lot to cover. And of course, it's more political than usual. I don't get political most of the time, but it's hard not to with this unusual election coming up. First of all, last week I showed subscribers in an update, Andy Pancholi, my co-author, 0 Hour in London. In his newsletter, he had a new pitchfork pattern, one of his famous patterns that he covers, showing a downtrend after the markets looked like they were marching up into the election. And that is still holding. So I will be updating that. We had a big downturn on Monday in the markets, unexpected, with the COVID crisis still marching up. And that gives more credibility to we may go down in the markets and then reverse up with whatever delayed stimulus plan comes from either candidate. And of course, this election could be contested, so there's going to be a lot of stuff there. So I'm still in the mode that either we go up into the election, and that's a good time to lighten up or get out of stocks, or we go down and then we look for maybe one more rally into November, maybe early December, before a bigger downturn hits. And again, a lot of my thinking here, and this is from a lot of business experience as well as economic analysis, there's lags. The stock market is known for being ahead of the economy 6 to 9 months. When there's a big stimulus or something, or money supply expansion or something, well, it takes 6, 8, 9, 10, 12 months to kind of work into the economy and et cetera. Well, I think this COVID crisis, I still think was the perfect trigger to a bubble that just has endless stimulus behind it, and governments willing to go to any lengths to prevent any recession, any major downturn in the markets, which is horrible policy, but it was the perfect trigger. And I think what happens is on about a 9 to 12 month lag coming into late this year, early next year, all these zombie companies that were never wiped out and restructured their debt, and during the GFC, the Great Recession, and now have been kept alive even longer. And this 20% of the economy, okay, yeah, the 80% may have had a V-shaped recovery. Of course, governments just literally replaced the lost income for consumers and businesses. Shazam, forget this crisis. Here's the money, pretend like it never happened and keep spending. But what about those other 15 or 20% of industries, the ones just getting hit by this crisis, continuing to accelerate longer than it should have? All the hotels and travel and entertainment and parts of the restaurant industry, they're not coming back to normal anytime soon. Cruise ships just got hit in this crisis yesterday of the stock market decline. So there's lags. And I still say between like December and the first quarter of next year, you are going to see this other shoe drop. And I don't care who gets elected and what stimulus program comes up. But when they come up with that next stimulus program, which, by the way, who blocked this second stimulus program? Anybody know? It was the Senate Republicans. It was Mitch McConnell, who may get thrown out of his own seat, along with Lindsey Graham and some people here. So that's what happened. Whether Trump gets in and they flip the Senate for the Democrats, which is more of a scenario than most people think, he's going to needs to come up with a strong stimulus plan, and the Democratic Senate will be behind him 100% on this. Or if Biden has a sweep and wins the Senate, then that's what the market's looking at. I've always been surprised the markets aren't just going, oh my God, since the polls say Biden's going to win almost definitely, we're going to have higher taxes than corporations, and then on the higher earners in our society, and these are the people that feed the bubble, the higher earnings from corporate tax cuts and the high income people that own most of the stocks and financial assets, which are bubbling way more than debt. So lags. And I think this is happening one way or the other, regardless of who gets elected, but how the markets react will be impacted by this election. So I want to get to something else here. There's a guy, Robert Cahalan, I hope I'm pronouncing his name right, at the Trafalgar Group. He was the guy that in 2016, when the polls were saying Hillary's got clear leads and they're growing, and even in swing states in the Midwest, and he said Trump's going to win, and he was right. There was another polling agency, Big Chart Polls, who also said the same thing. I was just reading an in-depth article by him over the last few days. I've really been digging into this. And he's saying what really should be kind of obvious in a way, human nature. Even on polls, people, when you have an extreme candidate, is Trump an extreme candidate? Okay, he may have started out in 2016, people knew, wasn't a politician, swashbuckling, wheeling, dealing businessman. Okay, yeah. But now, and particularly after this first debate recently, it's very clear who he is. Love him or hate him, he's lying, cheating, fight dirty, whatever. Okay? And all he does is attack his opponents vehemently. He is not a nice person. You would not want your daughter to go out with him, I don't think. Okay? So, being an extreme person, even people who love him, a certain percent, will not say in a poll, oh, yeah, I support Trump. In fact, these pollsters are learning to ask people, they don't ask them who they are going to vote for. They say, who do you think your neighbor is going to vote for, to take it off them? So there is a bias. And with Haley and this big data group adjusts the present polls for the biases last time. And remember, even though the poll leads are a little stronger for Biden than Hillary versus Trump this time, because Trump has lost some of his support, the bias towards Trump is going to be, I think, stronger than anything. What they show in a nutshell, especially Haley, which I'm looking at, Florida is the key state out of 7 or 8 because it's the largest swing state. He is behind by about a point in the polls, close, but this poll would say he's going to win Florida, maybe by a point. A lot of the swing states, he still may be behind the poll. Georgia, North Carolina, Arizona, Ohio, these polls adjusted would show he's going to win those swing states. It would also show, though, he's so far behind in Michigan, he won't win that one. So it comes down, and this is something Biden said the other day, it may all come down to Pennsylvania. So if Trump does win Florida, which he absolutely has to, and even Biden to have a shot here, these other states, and he gets all these other states I just mentioned, he has got to win either Pennsylvania or Wisconsin, and particularly Pennsylvania. Now, these polls adjusted show, and this is where it gets really iffy here. Yeah, Florida tilts slightly to Trump. Pennsylvania is absolutely neutral. It could go either way. And Wisconsin, the other swing state that's very close, and Trump is not guaranteed to get even, is Wisconsin, and that's tipped just slightly towards Biden. So Trump would have to win all these states, Florida, all these other swing states, and get Pennsylvania, and he could still then lose Wisconsin and Michigan, which seems more likely. So this could still happen, folks, even with the polls. And think about this. I was listening to Larry Williams, a really good stock and financial analyst. With all these polls being so overwhelmingly favored Biden, all it does is give less incentive for young people and the Democrats to turn out, okay? And past analysis shows that the stock market likes the incumbent to stay in power regardless of who they are. So again, I think a likely scenario here, which I think the markets would like at first, is that Trump ekes this out, even if it's contested, even if it takes days and stuff, and that's going to cause some confusion. He ekes this thing out even more against the odds, but the Democrats win the Senate. What does that tell the markets? And I think it's the best of both worlds for the market. Trump is a veto against tax rises, okay? And he's not going to start it, and he's going to veto if it happens. The Democratic Senate says strong stimulus, okay? And Trump wanted this stimulus program. It was McConnell and the Republicans that fought it. They wanted both to wait and use it as a tool, a bargaining tool, to get the Supreme Court judge confirmed, the conservative. And they don't want to look. I mean, they are drawing a line, believe it or not, after being just as fiscally irresponsible as the Democrats and anybody in history. Everybody's blown it over this bubble. Any amount of stimulus, they kind of say, well, wait a minute. We don't want to be totally fiscally irresponsible. Because again, printing money blows up financial assets, but fiscal stimulus creates big deficits. And big deficits also are positive for the market short term, but negative long term. So again, I think with this change on Monday and with Andy's pitchfork pattern, which is working out beautifully so far, the good thing about that pattern, why I'm following that one particularly closely, is that if we are going to break up out of this and go up in the last 3, 4, 5 days of trading before the election, we're going to have to break out pretty soon, and it's going to be pretty obvious. If not, we go down in the election, and then I'm going to be presuming that after a few days or several days of confusion about who actually wins and contesting and God knows what else happens here, that somebody, Biden president with strong Senate, or Trump now president, incumbent, reelected with a stimulus-oriented Democratic Senate, which are two like clouds, we see a strong stimulus program and the markets go up one more time before the inevitable hits. We are not getting back to normal after this virus, and this 90-year cycle is the most potent, particularly for financial assets, bubbles, and the stock market, of all the cycles I have, and has been the most important and obvious cycle since the Industrial Revolution, elevated the technology, the 45-year cycle, and the double one that causes these great bubbles. I say, I don't care how much stimulus, they don't beat this cycle, and this cycle hits the strongest in 2021, starting soon. And yes, the thing about this cycle, and all cycles are different, this cycle is extremely consistent on the bottoms. Late 1842 for stocks and financial assets, 1843 bottom for the economy, late 1932, the next big 90-year cycle, and 1933 bottom for the economy and real estate and other sorts of things like that. So this cycle is said from the beginning that late 2022 should be the worst part of the stock market of our entire lives, and I've said that for 20 some years before all this happened. And on top of that, my harmonics of demographic cycles, I call it 20, 40, and 80. Okay, 80 is a full 4-season cycle, 2 generational booms and busts. 20 are the cycles in between, and 40 is the generation boom and bust cycle. Okay, those all point to a late 2022 bottom. So I say we get serious about the downturn. The real top, and I'm going to show more evidence of this ahead, and in the November issue of the newsletter, which, by the way, it would normally come out on Monday. After the weekend, November 1st hits on Sunday, but I'm probably going to put it out on Wednesday morning, a few days later. I want to at least see what happens election night and see if it's clearly contested or not. But we should see some sort of strong stimulus program either way. So I think if the markets go down, they're going to go up, and then we're looking for a major peak. And we may not even quite get to the highs. We'll see. But a major peak and reversal, I'd say, by early to mid-December at the latest. I do not see this bubble or recovery lasting into the first quarter of next year. I'm very strong about that. I'll always change if I have to. So again, subscribers, be looking out. We've had a lot of updates. There's going to be more this week. Look for the newsletter to come out probably Wednesday morning, just after the election. And we have exciting times ahead. And again, if you see this crash coming, it's going to be the best opportunity of your lifetime. If you don't see it coming and you wait and see if I'm right, the next crash is due to be as strong or stronger than the last one. And remember, and I've been saying this for months now, every correction since the January 2018 first bubble peak and sharp correction, every correction has been deeper and taken us to new lows after the stock market hits new highs. Wherever we hit these highs here from September 2nd to maybe early December, I think this is it. I think increasingly, and remember my perfect chart from also about a week or so ago, convergence of the top trend lines long term and from this super bubble by QE from 2009 bottom up says we are peaking right in this time frame. So again, stay tuned, lots more coming.